Well, good afternoon, everyone. This is Mark Robertson with the 506 Investor Group. Today, I'm proud to introduce Alex Chukri with the Pravati Capital Fund. He's going to talk about the Pravati Credit Fund 3, and then after that, we'll go through some questions. How you doing, Alex?
Good. How are you?
Oh, doing just fine, thank you. Appreciate you taking the time to do this.
Yeah, no problem. I can jump right in if you'd like.
Yep, if you could just go through your part of the presentation, and then we'll go over questions at the end.
Okay. Yeah. So I'll start pretty quick here. My name is Alex Chukri. I'm the CEO of Pravati Capital. We are launched our new fund, Pravati Credit Fund 3 LP, on Friday. I'm just going to flip through some of these presentations. Oops. We have been in this business of litigation finance. I have personally since 2003. We are investing in these types of asset classes for quite some time and have a pretty extensive background in it. Some of the differences with Pravati Capital is that we are focused on late-stage litigation finance. So one of the things that we've learned throughout the years is that the longer you wait and you're on the sidelines for certain cases, a lot transpires in that time frame, and we're able to make better investment decisions because we can read the tea leaves a little better. So the analogy we use is we like to come in at the fourth quarter of the ball game, especially on your pharma and mass tort type cases. One of the key distinctions that we have is that everything is in pooled assets. So we do funds. We go into a law firm. We look at all the cases in the law firm. We underwrite those cases. We put a lien on those cases, and then we have future cases that we also lien. So we're fairly well collateralized on that. And then obviously that fund goes into our credit fund. Our other key ingredient is loan to value. We have a very low loan to value. We look at every case. We determine what the value is based off of the 16 years that we've been in this. And just historically, certain asset classes have settlement timeframes. And then we decrease that. Typically, we end up decreasing it by 50 to 70%. And then we only loan on a 25% loan to value. So if it's a case that's already settled, that's truly settled, we'll give it a little higher value. But typically, if it looks good, we decrease the value pretty significantly. It's really hard to get data when it comes to litigation finance, what the size of the industry is. Based off of the competitors and what's happening in the UK, I would say this is a $7 to $8 billion investment a year amongst all of the big competitors and some of the smaller competitors. So I think you're seeing your mass tort cases, so the bad cases are the bad commercials you see on TV with the pharma and trying to generate leads. That is each one of those tends to be between 1 and 5 billion in settlement value over the course of their time frame. On the commercial side, there's usually significant dollars placed into those. And then on the personal injury side, those are lower dollars, higher volume. But all in all, in trying to research and get a good number, I think that internationally, that's the numbers is probably close to, call it 8 to 10 billion a year that's invested in the space. The new offerings, it's your typical SP or GP LP structure. We have an administrator, UMB, Greenberg Traurig, New York. Their fund division did our work. We have been working pretty diligently to become institutional ready. This particular group a good job. That the documentation took about 6 months to pull everything together. So that's who our fund counsel is. I think it's smart to look at the returns on this, is to be in the mid-teens to low 20s is what we tell the investment groups. Even though the fund is doing much higher than that, we think it's a good expectation to set your sights at 15 to 20% returns on your money per annum. Typical waterfall structure, 100% of the capital returned. We do pay at 8% pref, but the 8% is paid quarterly, so 2% a quarter to the investment community. We also, when the case settles, we return the capital back to the investor, other than the discretionary period we have for 1 year for recyclement. So back to the waterfall. So the capital is returned 100%, 8% pref. Management gets a catch-up, and then it's your typical 80-20 incentive allocation. The money is on a drawdown structure. We see drawing down at a minimum of $5 million immediately. We're getting subdocs out now. We have a lot of current investors that are ready to re-sign, so we're confident that we're going to hit that $3 million hurdle pretty quickly. So one of the things that we've learned through all the years of doing litigation finance, and I'll get to my background when the slide comes up, but we learned early on that it's much better for your risk mitigation to put everything in a portfolio and do a loan against a portfolio. So, you know, the nature of the beast is that these things, when they don't settle, you're not going to get hit very hard. We have very strict concentration rules for that, so we sleep pretty well at night, knowing that we're not so over collateralized that all the great cases that we funded and did well with are all going to come down because we made one riskier size. We do see a lot of different opportunities, and we're working with other partners now to still take those investments, but bring in capital so it doesn't hurt our concentration limits. But for the most part, 94% of our portfolio is in a pooled environment. So they're law firms. So you have a law firm as a portfolio, and then obviously that portfolio is pulled into our portfolio. So we focus a lot. Our strategy is hitting the second, third base, right? We're not concerned about doing home runs. We're more focused on small bumps and doing our collateralization to mitigate risk is our most important aspect. On funding terms, typically the advance rate is 25% loan to value. One thing that we do is we charge the law firm a fee for all the origination. Now, those origination expenses typically hover between 3 and 5%. That is a revenue stream to the fund, and what that does is it decreases the cost of the fund. So our objective has been to try to pay the majority of the expenses of the fund through this 3 to 5% origination fee, which is the law firm. Like if you do a hard money loan, there's some points up front. It's really no different than that. Now we have brokers that we pay. You know, there's a lot of marketing expense that we have, and those are all taken care of. And in essence, it just decreases the cost to the fund and bumps up the return to the investor. Typical terms of these, tend to be 36 to 48 months. Our last two funds, our current fund and the first fund, are right around that time frame, 36 months. So we And the reason why we feel very confident about that is that we wait for the later stages of the cases to fund. So when we're looking at portfolios, we typically don't do a portfolio if we know that it's 3 years for them to have some sort of adjudication to it. So we emphasize that to decrease those timeframes and thus try to get everybody's capital returned within a certain time frame, within 36 to 48 months. Part of how we're keeping consistent cash flow to investors is that because of the portfolio structure, we're able to collect revenue from the firm on a monthly basis. So we take a piece of revenue from the firm. Typically, it's anywhere between 25 and 50%, depending on the asset class that they have. For example, if they have a lot of automotive-related situations, car accident cases, because of such a high volume and low number, we decrease the collection rate on those. But typically, if you looked at all of our contracts, I would imagine most of them sit at the 50% collection rate. So we collect 50%, and we disperse that to the investors. We do have situations where we wanted the option that if we saw a portfolio that wasn't doing well and it wasn't coming in at the rate that we thought it would or how the firm thought it would, we would increase our collection rate from 50 to 75, even to 100. It's just another lever that we have that helps us make sure we get our capital back and our return. But for the most part, if we see something, it's a maneuver we can do that the firm agrees with right at the onset of the contract. So our underwriting process is pretty involved. A firm will come to us, we'll go to a firm, we underwrite their case. We do typically get a list of all the types of cases that they have. We then go through and make sure that case is legitimate. We then go through and make sure that what the firm believes the value to be versus what we believe the value to be. So this is where we really start to decrease the values there. Our objective is to be over collateralized. So we typically cut these by 50 to 75%, and then do a loan on 25% of the value. So it's about a 2-month process when you're working with the firm. We also get the complaints, all of the necessary documents with the firm on every case. So it's a long, drawn-out process, but it's thorough. Then at a pretty quick stage, we offer them a non-binding term sheet. The non-binding term sheet just lets them know before we spend hundreds of hours on diligence that this capital is going to be not cheap, and that they're fully aware. They sign the term sheet. Then we do a very deep dive. We use the tools like LexisNexis. We have an outside firm that does all the UCC checks on behalf of the firm and the lawyers within the firm. We do typical corporate reviews, their IRS statements, their P&Ls, their bank statements. So it's a pretty thorough process that we go through. And then typically, once all that's good, we provide our first term sheet allows us to increase if we need to. Then we go out and provide them the advance. And then what we do at the same time is we're starting to use better tools to let us see how the cases perform. So we're using View Access, what they call an IELTS statement. An IELTS statement is what every lawyer has. It's their IELTS statement that's tied to the bar. So we can view when cases come in. We have our accounting department do all of that work, and we can see what transpires. Then those monies are swept into a collection account that's got our terms in it, and we get paid directly. So as time goes on, we have built in all these extra, connecting of the dots to make sure we're paid. The one thing to understand, we are a little overkill when it comes to making sure we get paid. A lot of our partners, a lot of our competitors don't use that tool, but they rely on the fact that for the firm to pay them. And the reason why they do, it's a fairly large hammer, and that the law firm, if they want to continue to practice law, they're not going to defraud you and not pay you. So they typically are very good about sending us the checks, or sending us our money when it's due, and being pretty transparent, because it's a fairly aggressive approach that we have the ability to take. So the litigation litigation finance business as an asset is interesting in that it is really uncorrelated. I was involved in, had a fund just like this, and it was when the 2008, 2009 timeframe came through. We really didn't see much of any movement as far as potential problems in collections. In fact, what we did see is people looking to us as a safe harbor to make investments. So, it's easy for a lot of firms. I just came back from a Context Summit, a lot of people claiming that they're all weather, they are very well securitized against these types of things, and litigation finance clearly is. It's, most of our cases are paid by insurance companies on the plaintiff side. On the commercial side, if there's a situation where a commercial entity is suing another commercial entity, obviously that's one of the first things we look at is what's the viability of that entity, what's their ability to pay. So we dive into that pretty well. What we like about this asset class is it's got a relatively short duration. If we were to fund earlier stages cases, I still think that would be in the world of investing in these types of asset classes, it'd be a 5 to 6 year window, but we are specifically focused on later stage cases with this fund. So a lot of the other competition in the real estate assets, they tend to have, as you guys probably know better than I, 8 to 10 years in time frames where your money's caught up. This is one of the reasons why we like what we do and work as hard as what we do. It definitely has a social impact to it. We are in the David and Goliath business, supporting David. I can give you a lot of examples from a guy that's a construction worker that they had a utility truck lose its brakes, went right over his car, couldn't work for a year. Insurance company was not, insurance company wasn't stepping up and paying him. We stepped in and just gave him a mini bridge finance. We knew the case would settle, but it was that when cases tend to be $300,000 to $500,000, they don't settle as fast as you'd want them to, especially if you're a plaintiff. So we were able to step in and provide that bridge. We've had situations with a broker dealer that he had an issue with one of his clients on a transaction that the broker dealer didn't do. His client went out and sued him anyhow. His insurance didn't kick in. He's got 3 kids in college. He's got $250,000 in legal bills. We stepped in and helped him, bridge that gap. We've had guys that have been wrongfully imprisoned for 7 years. They got out of jail. They lost. The guy was the CEO of a company. We were able to step in, provided him cash flow for a couple of years. We did extremely well in that case. So at breach of contracts, we get cases in every day. We've had guys with their second and third pacemakers that doesn't work. And when you're suing your doctor and your insurance company, they tend not to want to refinance or provide you those kind of fees that you need. So it gets to be an ugly world out there when these kind of things happen. The key thing is that where we're seeing a lot of interest is that, publicly held companies that have performance records that would rather do this on an off-balance sheet situation where they fund the cost of their expenditures on litigation off balance sheet so it doesn't affect the performance of their fund. That is a very big deal with some of these bigger corporations where they don't want to expose any of this from a balance sheet perspective, and they offload it to companies like ours. So we like those opportunities. We're extremely cautious when it comes to those types of things. Typically, we fund for every case that we fund, we've looked at 30. So that's from the social impact side. I think that we do something good. We've been since we've been reporting our numbers, we've had Bloomberg notice us 3 times now in the asset-backed loan hedge fund category for being one of the top performers, 1 to 3. And of course, when we got this information, it was hard for us to believe. So we went through and double, triple checked all of our accounting and all of our numbers with Bloomberg and our Barclays, I'm sorry. And we're dialed in there. So we expect to have these continual type of returns. From a risk management perspective, I think the way we mitigate risk the most is through portfolios. You're in the litigation business; things aren't gonna work out the way you think, especially if they go to court. 85% of these cases that we fund never make it to trial. They're funded way before trial ever hits. The kind of the detail that we get into on the cases we look at pretty thoroughly. Every law firm that we fund, there's a couple cases in there that we don't agree with or that don't necessarily have the value that they think. So we just zero out that value, but we still collateralize it. We still keep it in our systems, but we're not counting on that case to settle for to get our investment back. So we do that on occasion. You're not always going to agree with the law firm. They're going to take on some pro bono stuff. They're going to take on the situation in Colorado a few years ago with the theater shooting, where they had a couple of those clients in there. We didn't think they were going to get paid, but we zeroed them out. Terrible situation. We zeroed them out, but we still got our capital back from the firm in a return. In some cases, we use very sophisticated qualified settlement funds. So if a law firm is expecting $1 to $2 million back from one particular entity, we will use a qualified settlement fund to do that. We constantly are rolling between $15 to $30 million in pipeline. We have cases that just came in yesterday that are fairly extensive. So we consistently have a $20 million pipeline. That's why we're going ahead and just getting to the $5 million drawdown on this fund. So on the kind of the business highlights, our fund is doing our current fund is hovering in the 36th percentile range, the return to the fund without the fee to us, without the incentive allocation fee to us. The first fund is hovering around 21%. So I mean the funds are doing well. I mean when we get cases, we do our best to get as much dollars invested as we can for the highest rate. And I could take any other questions if you like.
All right. I mean, what's the tax implications when is this just interest we're earning, or is there any capital gains? What's the tax implications of investing?
No, it's income only.
Income only.
Mm-hmm.
All righty. And I'll just go through our questions. When or what was the first closing date? When will you call capital, or did you call capital?
We're calling capital. We're calling capital now.
All right. And your current commitment is how much?
Current commitment is 5 to 10 on our current investors that have so we just got the offering out last Friday.
Yep.
But in our conversations, so I would say soft circled 5 to 10. That's where it sits as we speak right this minute.
All right. And how much capital is committed? I mean, how much committed capital is earmarked to be funding loans?
5 million.
5 million.
5 million.
And so that all the income is income. If I invest the minimum 100K via a self-directed IRA, what would be the expected range of annual UBTI issues or UBTI?
No UBTI.
All right. And you accept solo 401K money?
Yes.
And is there a reinvestment option, or is everything distributed?
Everything's distributed, but you can pay. Once you're in, you can reinvest after you get your funds from us.
And that reminds me of a question I had earlier. What is the penalty or procedure for accepting money later versus early money, as far as the returns?
All right. Are you talking about how we kind of even out the share class of the investors coming in first versus investors coming in later?
Yeah, I mean, essentially, if you come in later, you would potentially earn more income, since the income was probably back-ended a little bit, and the preferred.
Yeah, actually, it all gets everybody comes in as if they were in the fund day one. There's a catch-up provision that happens at the time of the new investment, where you essentially pay your pro rata amount of the investments, the cost of the investments, as well as any expenses at that point in time. And then there's a nominal rate that gets added to that for the time from the initial closing to the closing that later person would be involved in.
So
we can send you a detailed example of that too afterwards.
All right, that might be easier just to look at it. Very good.
But it keeps every investor on a level field for the fund.
This was a Greenberg Traurig. This is exactly how you do it. What do you want to become an institution clause? They call it a square up clause. We'll provide that to you.
All right, very good.
It's in the offering.
Yep. And in the Fund 3 presentation deck, one of the slides says 25% loan to value. But what is the definition of value that you're using in your loan to value?
So the value that we determine is the value we give the cases. So I'll give you an example. We looked at and we funded some cases that dealt with the BP oil spill exchange, and that was the firms believed that their value, their case value as it pertains to the income that they were making. So their legal fee value, they thought what they were going to generate was 30 million. We reviewed all their cases. We hit it at 12 million and then lent only 2 million on it. And that was over time. So when it comes to value, we determine what the value is based off of our knowledge, our 17 years of experience in the space.
And I guess the follow-up, do you use any industry statistics to determine the value?
Yeah, I mean, look, we see the statistics. I think we understand them well because we've seen it as an investor, investing in the space. We take the statistics, especially if they come from lawyers, we decrease them dramatically. So it just depends on the asset class. If you could talk to 100 personal injury lawyers that deal with car accident cases, they'll say that they typically see those wind up in 12 months, regularly, not very long. Now, if it's a $1 million payout, that's going to go longer. If it's a $25,000 payout, it'll be a little shorter. So there's a lot of things that weigh those. The mass torts, we don't fund any mass torts until they go to the bellwethers, which is when the law firms and the defense firms, plaintiffs and the defense firms, go head to head, like you're seeing in talc and some of these other things that you see, these large losses or these large wins. Until that process, we don't fund, typically. There are occasions when we do, because we know they're not going to make it all the way through those. So I guess the very short answer to your question is that it's statistical value that we see in the market for 16 years, and it's weighted based off of a lot of things that that we see as important.
And is the interest rate determined by the case? Is it negotiated? Is it a flat 25%? How do you determine your interest rate?
So industry standard on the portfolios with law firms tends to be 18. It depends. It depends what it is. If it's, let's just say it's a firm that's got 2,000 cases and they're all motor vehicle related, then I'm going to be very, very happy in the high teen range. If it's the new mass tort called with IVC filters, which is a mass tort that's just getting ready to go through that process, we would hit it in the early 20s. If it's a commercial case, we're looking at a commercial case right now. It's toward the end of it. It's one case. We're hitting that at almost 36%. So it's commensurate with the risk that we're taking, and it's also commensurate with what we can get as a flat-out businessman, entrepreneurial type entity that says, look, if this firm's getting X amount of cases, I think we can fund a little more and charge a little more. So, but for the most part, it ends up in those categories.
Are you ever bidding against other firms, or is it just a relationship-based business? We're seeing some bidding here and there. The way our term sheets are set up, it really doesn't allow them to go bid up against our term sheet if they signed it. What you find is that the legal world doesn't have the necessary time or knowledge to go out and call 10 of us guys and do a comparison of what the difference is between this particular funder and another one. I think this is why we've done well, is that they know us from all the conferences. They recognize the name from the early days of doing this. So a lot of it is relationships. But once they find a firm that's interested, if they got to pay a couple extra points, it doesn't seem to bother them much. All right. And to use leverage on investors' capital? Yes.
So on our last fund, we had about 30% leverage on that fund. On this fund, we can go up to 50%.
And your goal is what for this fund?
Our goal is below 50%.
And what?
Now, we've had a lot of offers. We've had a lot of offers of 80%. We just think that's too risky. It's a function of having enough capital to meet the demands of the business. If we could do it all in capital, that would be fine. But we had bank leverage at 7%. That was a great number for us. We took that revolver down, I think, almost 3 times, and it was very helpful. It's very helpful to the investors.
So you're using that just to juice returns, essentially. Use the leverage. And,
we use it
for capital.
Yeah. I think we'd probably use it less if we had more capital to deploy. That just hasn't seemed to be a situation that we've had to be able to take advantage of. However, the leverage is nice. It's not like overly expensive leverage with daunting returns. I mean, there are daunting agreements behind them. They're pretty reasonable.
And it's all with banks for the most part.
One bank and then two credit facilities in the 10 to 12% range.
And what's the 7% money is with the bank? How much of the loan will they provide? Is it half, 25%?
That's the reason why we have the credit facilities, right? Because they're willing to go 5 to 8 on this one. They did 3 on the first one, so 5 to 8. However, it's a revolver, right? So I can take it up and down as I pay it off.
Yep.
Case to settle, or if I want to sell it to one of the other SPVs.
All right. Can you describe
that? We also.
Okay, go ahead.
Yeah. So the way the SPV structures are, and there's only 2 of them, and then the third with the bank. The SPV has a senior credit facility in it, and then there's our fund, and all of the dollars that we invest into the credit facility, into the fund of the SPV, are only subject, if there was a catastrophic loss, they cannot reach back to the fund. They could only stay within the LLC, within the SPV. So hypothetically, $10 million is put in by the senior on the SPV, $10 million is put in by the fund. If there was a loss, the maximum amount the senior lending entity would be able to do is that $10 million. They can't go back to the fund.
Oh, that's good. Can you describe the competitive landscape of similar finance litigation providers?
Well, you got. So we've been doing this for quite a while, and you have a couple of behemoths out there. Bruford being one of the bigger ones, and Bentham, and their minimum investment tends to be $3 to $15 million. So what's nice about this is our target is $500,000 to $3 million. $500,000 to $3 million. That's a great sweet spot for us. They don't even really look at it there. On the plaintiff funding, the John Q. Consumer plaintiff funding, there's probably 80 companies out there that do it, bootstrapping type. We belong to the association, have been a member of the association almost since its initial formation. On law firm loans, there's a couple good-sized guys, $800-900 million under management. Similar structure to ours. Here's what's happened. When you talk about running a company like this, you got two headwinds. One is explaining it to the investors, and then trying to explain it to investors that really dislike lawyers. That's always the challenge. and then you have the same headwind of explaining it to law firms that aren't bankers, that don't know much about finance. That A, they could do it legally, and B, it's something that they should do. Once they understand it, they see a lot of ways that they can utilize our funds. So those are two big challenges. So what I like about our position right now is I think it's a land grab opportunity, and we're spending a lot of time in Southern California, Northern California. We're funding firms all over the country, but Southern California is, California in general is the sixth largest economy in the world, and there's a lot of different types of assets that are fundable. Everything from the cars, from the personal side to the commercial side. There's just a lot. We get a lot. We have people on the street in California going to firms every day. So we're really throttling up our sales initiatives.
And on the different states, it brought up another question. Do you have K-1s for different states, or is it just one consolidated K-1 and you don't have to file in different states?
All in Arizona, one.
All right, good. And how much capital is being provided by the sponsors into Fund 3, net of fees?
So on the loans with the bank, we've personally guaranteed those loans into the fund. About $100,000, $200,000 is being initiated to start. But our biggest contribution, skin in the game, is our PG on the bank.
And how much was in Fund 2 from the sponsor?
$3 million.
$3 million. And the presentation refers to 16 years of track history. Any details that you can provide prior to the founding of Pravati?
So I was co-founder of a company called American Legal, me and two other partners. So we were one of the first movers in the space. So in 2003, I bet you there was less than 10 funders in the space. So we went through that process, 3,000 cases, invested in probably close to 70-80 million AUM. It was a good way to cut our teeth. So I was also on the board of American Legal Finance Association as the executive, one of the executive committee chairs. So look, we've watched this grow. We understand it. We understand, more importantly, the legislative aspects of it. We understand our competitors. We know who our competitors are. We all kind of do stick together, especially if there's ever any problem. We share databases of cases and individuals and some other entities that we have to stay away from. So overall, I think we're we've just seen a lot. We've been doing this for quite a while. Our underwriting shows it, and we're taking a lot of that underwriting, and we're in the process of developing artificial intelligence to help us score the cases so we can scale a little better and provide a software structure under the company. So we know that particular judge on this particular case, this is how they went in the past, to your PI cases of what typically transpires and what you need to be careful for in California if you're doing them versus what you're doing in New York or Arizona. So we're building that database structure and going down that path now.
All right. And how much data on individual cases and the results from your track record can you share? Or is that NDA stuff?
Well, I mean, most of this conversation has probably been NDA stuff, but I don't know what to. We just got a lot of data points on certain assets that you want to fund. We use a lot of what's happened
before, that 94% or something, or for like personal injury cases, or one or something. Or is there any statistics like that you have?
Yeah, so 84 to 85% of most personal injury type cases settle before going to court. Of those, a higher percentage is actually paid. So oftentimes you will have success in making sure that we did our underwriting correctly. Where you have a challenge is, did you overfund the case? So if the case was supposed to settle for $100,000 in your numbers and in the lawyer's projections, and it settles for 50, how do you work that out, right? And so we're always very good about making sure we get our capital back and taking a smaller return. So, we know that in some of these large mass tort, pharma mass tort, that on a drug that's doing $2 billion in sales a year, they're also writing checks for $800 million on, or $500 million, just depending on which one it is, because of the people that it's hurt, right? So we understand that it's a business, and we know we have all the statistical data that shows what's transpired across the board in those different asset classes, those mass tort asset classes. On the commercial side, there's a lot of data that we have in our systems that say that, if this particular case, is really worth investing in the Volkswagen case when the average value of a car went down by $2,000. Is that really something you want to do? Because this is what it looked like with the key the Chevrolet key incident where the key ignitions would turn off, right?
Yep.
What was the real damages there? Well, the real damages there were only in course of people that were having accidents or died. The guy that was a part-time janitor that had 3 pounds of keys on his car, there's a reason why you hit a pothole and it turns off. I mean, we sit in these conferences on a very regular basis and take in this data as an investor.
All right. And back to the sponsor capital, you put $3 million into Fund 2 and $100,000 or so into this fund. Why the drop?
So in Fund 2, we personally guaranteed the $3 million that went in a Fund 2. We're personally guaranteeing the $3 to $5 million that are going into Fund 3, and we have $100,000 of cash going into it. Now, when we started the company, we did $250,000. I did $250,000 to get the thing going, on top of investor capital. So it takes time. We're the last man being paid on the waterfalls, so we get our investors' capital back, their return, and then we take our fees. So that's the reason why. I mean, that's just where we are right now.
All right. And do you plan to fund the same law firms as in the past, or new firms, or I guess a combination of both?
Combination of both.
Yep.
Mostly new firms.
And how much capital in Fund 2 has not been deployed, or is it all out?
There's probably 300,000 that hasn't been deployed yet.
All right. And that's soon to be deployed,
So
or will be returned? If you don't find a place for it, will you return it to investors, or how does that work?
No, we'll deploy it.
All right.
So look, we're in that hard spot, right? We're closing one fund down and we're starting another, and as soon as we get the minimum met on the other with subscription agreements, then we can officially go into Fund 3, right? So we're in that spot where we have a little bit of capital in Fund 2 that we expect over the next couple of weeks. We're going to deploy that money. We certainly have a hell of a lot more than a couple $100,000 to deploy in the context of where we can deploy it. We're starting to do the two-step now on some of these firms to making sure we can get their capital out that they wanted in a timely basis. So that's why we're trying to get the Fund 2 launched immediately.
Yep. And what is the mechanism by which the firms get paid? What checks and balances are in place to prevent fraud?
So when every month we get the activity report for their IELTA account and their operating account, and we check that on a monthly basis in the arrears. We also use qualified settlement funds. Qualified settlement funds is like an escrow account where the money goes into an escrow account. Typically, it's a lockbox. The money is sent to the lockbox. But we have every month, every week, we're calculating what's owed, what the process has been on a quarterly basis. We've had a call with the firm, and we've got their new cases as well as what's been clarified. So we're very high touch.
All right. And how many law firms do you invest in? What's the diversification factor?
25 right now. 25, 24. We'll add 2 or 3 in the next week or so.
And is it concentrated mostly in California, or is it pretty spread out?
It's pretty spread out, but we have those 20 firms, there's probably 7 or so that are in California, I think. We don't think that jurisdictionally or geographically there's any real concentration issue, unless you have some horrific earthquake or situation along those lines. But our cases don't go away because of jurisdictional issues or geographic issues.
Are there any states that you will not invest in, or is it pretty? Are there any?
There's no states there. So you got to break them up. So on the plaintiff side, there's probably 12 states that we won't invest in, or if we do invest in, there's certain components that you have with ceilings and minimums and what have you legislatively. And then on the commercial loans, not really. There's really not any particular state we can't lend in. In some situations, you need to be registered. But again, litigation finance is fairly new, and it's kind of going through that process of letting legislators and regulators know what the parameters are. Some people think it's like a payday loan, and there's an absolute right of repayment where really our investments are tied to the success of the cases. So once that understanding's done, it frees up legislative concerns.
Yep. And where do you get your deal flow? Is it organic or sourced, or just?
It's mostly organic.
All right. And I'm not real sure what this is, but what percentage is NF litigation versus other types of lawsuits, and does the PPM set strict or flexible guidelines for this?
I'm not sure what NF means.
I don't either. But I guess, is there any limits within the PPM about which type of litigations you can invest in?
No, but if there's concentration limits, right? Then obviously we have a ton of limits within ourselves. Now we're not going to go invest in a divorce case. We're not going to invest in a brand new mass tort that is just being formed. A guy that gets into a really bad car accident yesterday, we're just not going to write a check into that until we know what the coverages are. So we kind of provide our own scrutiny to these things.
All right. And what sort of reporting do you provide your investors? Frequency and transparency, et cetera.
On a quarterly basis, they get a report that talks about how much we funded, what their current position is, what the loan to values are. A pretty comprehensive report that comes right from UMB.
All right. And is there a dashboard that is updated in real time as far as milestones about specific cases, et cetera?
And on a quarterly basis, there is, and that's in UMB.
All right.
The UMB dashboard.
All right. The fund uses capital calls, but per the PPM, the capital call period seems to be able to extend extensively into the life of the fund, 4 years per PPM, page 4.
Well, I haven't had a chance to go back and double check that, but it's only supposed to be for 2 years.
All right.
Yeah, it's 2 years. So I'm not sure where that question came from, but I probably need to double check it. But
all right, if you could email me on that one, that'd be great. Same thing, page 12. An indemnification clause requires LPs to potentially pay unfunded capital and already paid distributions for up to 3 years after fund dissolution. Please explain this scenario.
I think that scenario is on the basis that the company comes apart. I guess it's a dissolution based off of the lack of performance on capital raise or lack of performance in general. I read that question like 4 or 5 times and referred to it on the offering. It didn't. I think it's just it's a boilerplate contractual language. It just discloses that if I think it's an indemnity. Are you talking about the indemnity?
I honestly am just reading the question. I didn't look at page 12 myself.
Yeah, I think it's the indemnity, which basically says that if something goes south because of everyday business or regulation or one of those, there is no recourse back to the manager. But if it's wrongful or willful mismanagement and et cetera, where it's a bad acting on the manager's part, there is recourse.
To the manager or to the investors?
To the manager, if I understand the question correctly.
I mean, it looks like the way I read it, that the limited partners potentially have to pay unfunded capital for up to 3 years after fund dissolution, is what the question's saying. That we have to pay more liable.
I can go back and get. Yep. I can go back and get an English translation on that.
Yep, that'd be good. You can send that to me too. The wording, it sounds troublesome, but I don't know exactly what the wording is. So
right, yeah,
look into that.
I wasn't exactly sure, and I didn't have a time to call Greenberg before I got on the call with you guys.
All right, that's fine. And what percentage of the fund will be personal injury cases?
I'm not sure. I mean, I hope that it's at least 30 to 40%. We like PI cases. I mean, those are everyday insurance-backed. They're not sexy. They are just everyday revenue stream cases, right? So we like those cases. I'm hoping it's going to be in that range. I have to go back and double check to see what our last fund was. So yeah, what I think a better way to understand that is that they're going to be mature cases. They're going to be mature later stage cases. That's no matter what kind of asset class it is, whether it be PI or personal injury or whatever commercial, you want it to be later stage. So we believe we can get 150 million out in that arena for those types of the kind of cases that we're doing now.
All right. And how much does it cost on average to a sponsor in a highly public employee lawsuit like Pampelona's against Snapchat? What percentage of fund will be used for such cases?
Extremely minimal.
All right. The percentage will be minimum, or the cost or minimum?
Well, let's just talk about that. So we financed a really robust, new and emerging law firm out of Los Angeles, and they are bringing on great cases literally every day. And they did a case against a Snapchat employee, and we weren't super thrilled about it, but we're looking at the whole portfolio. You didn't know whether it had a lot of merit or not. I believe it was before Snapchat went public. But there's something that the lawyer sees that we may not see at times. But I think what we do in those kind of cases where we don't want to throw out the whole opportunity because of a couple cases that may be not to our pleasing. So we take them and we zero them. We make them zero value to us, but we still collect them. So they're still part of the portfolio. So I understand the scrutiny with that. I mean, there's a lot of different opinions on that one, but that's not something that you would think. That is a very rare situation.
All right.
For us to fund.
And do you have a debt product that investors can invest in separately? Do you currently have debt at the company level?
Well, that's funny you asked that question because we are certainly looking at that. Just a flat debt offering. And we've had one of our law firms, our securities firm, that's really tried to lead us down that path. And now that we have this fund done, we're considering, it's been a topic actually over the last couple of days. It's been a topic that this might be something that's just simpler, that provides a straight interest component. It's not going to obviously be anywhere as upside potential as the fund, but it's something that for some people may want to just be more of a simple product that they know every month they're going to get a check, and they know that the funds are backed by a lot of assets and backed by the manager. So yeah, we are looking at that pretty heavily now that we got the one fund done.
And it would be debt to supplement like the Fund 3, or it would be a separate fund in lieu of Fund 3?
No, it's. I can tell you that it's all hypothetical right now.
Yep.
We're just happy to get the Fund 3 done finally.
Yep.
And out. So all of our focus is on that now.
Yep. But I mean, I was just wondering if you're looking for debt to replace like the bank debt or the SPV debt and use this kind of debt, or just a different business model to play a flat fee instead of an 80-20 arrangement.
Yeah, I think the flat fee model is entertaining to both sides, right? To us, it certainly is.
Yep.
And I think to the investor, it's a sign of security that they don't need to be so concerned about all the different variations of what we're doing. They know that it's backed.
Yep. All right. How long does litigation last, and how much cost? I'm not exactly sure. When you get to the fourth quarter, when is the term's legal milestones? I will skip that one.
I don't understand.
I don't understand it either. What's the biggest potential risk that could cause the loss of capital? Legislative changes?
No. Bad. You know what? The biggest risk of capital is somehow financing a bad actor firm that's a thief, and they're out there, and they just abscond with your capital. That is the biggest way to lose dollars in this business, and that's why we do 2 months worth of due diligence to flush all that out. And we really work hard, because when you look at the ability to lose in this business, it's really on the ability to collect, not so much on the investment strategy. The investment strategy is sound as can be. The collection strategy is what's hard, right? I mean, that's the part where if you have a bad actor and they're a thief, they've bamboozled you the whole way through. Now, we don't see a lot of that. We smell that out early on when we do all the UCC and all the credit checks, that these guys are notorious for doing those kind of things. But typically, we don't run across those kind of bad actors.
All right. If we commit $100,000 now, how much is called immediately, and will it likely be in small amounts or just a few large amounts over the next couple of years?
Say that again now?
If we invest $100,000, it's a callable fund, right? Or is you pay it all up front?
That's a good question. So it's a call, obviously it's a drawdown fund, but the minimum drawdown is $100,000.
Oh, so if we committed 100,000, we'd pay 100,000 now.
Yeah.
All right. And can you give an example of a litigation you funded and walk us through the process of sourcing the case, doing the due diligence, funding, and how the litigation went through ruling or settlement?
Okay.
Or is it through the firms you really don't do that for the most part? I mean,
we can walk through the example with the firm. So we had a firm out of Denver a couple of years ago, had some cash flow problems. Typically the law firms are having a cash flow situation because cases take years to settle in part. So I think overall it was $100,000 funding. We gave them, I think, $25,000, and then we gave them another $25,000, then we gave them $50,000, and then we settled it up. And within a year's period of time, he made payments on a regular basis when cases settled, and we wound. He had us paid off in about a year and a half. So that's a fairly typical model of what our firms go through. They got a big portfolio. They have certain cases that have some expenditure to them. The bank will only give them give them money on their hard assets. They don't underwrite that. I mean, that's why we're in business, right? Is that they don't underwrite the case. They don't underwrite case level, and that's what gives us our opportunity.
All right. And how long will the fund be open to commit if we're not ready to commit now? How long will the window be open to invest?
Technically 2 years.
All right. But if he hits your 99 investor maximum, then it will be much sooner.
We're very happy with the kind of responses that we're getting now. So yeah, we think that we know our current investors are going to re-up, and we just came back from Context Summit, and we probably had $5 million worth of commitments there. And then we have another. So look, we've been selling this fund or getting interest on this fund for the past 7 months. So we're expecting that well, obviously we're not going to draw down monies that we're not ready to deploy, but we're seeing a pretty even track.
All right. Well, that was the last of the written questions up front. Let me see if there's any in the chat. How does your diversification look like compared to your product mix, percentage, per tort, etc.? How does your diversification? I'm not real sure what that means either. How does your diversification look like compared to your product mix, percentage?
The best way to look at this is that we're doing mature cases, so cases that are near settlement. So that's really what we try to concentrate on. So if we go into a law firm that's got a portfolio of 1,000 cases, we want to know that the cases that are in settlement are close to settling, that we agree with, are going to cover our capital. We look at that extensively when we do bigger investments. So we're not high flying anything. So it's a more mature cases, and obviously the loan to value is critical. So that's how we deal with, I think, what the objective of that question is.
All right. And that's the last of our questions. And I'll give everybody a minute if they want to unmute everybody if they have a question. If not, we'll wrap it up. Is anybody out there I just unmuted have a question? I guess not. Well, thank you very much for your time. I think it was very informative and we learned a lot, and look forward to investing with
Hey,
you.
Mark, there is a new chat question.
Oh, okay. I'm sorry. At one point you mentioned one risk was if there's a major earthquake. Can you elaborate on that?
Well, look, let's just use an example that just happened, right? I mean, if I had all of my clients in Florida or in the Keys, I'd be a little nervous right now.
Yep.
Right? I mean, I can't. We're not going to be able to estimate those kind of things. That's what I mean. If some natural disaster happens, but you got to remember, if a natural disaster happens, that doesn't change the case values. Depends what the case values are, but
just
the insurance company is still responsible for paying for that car accident that happened well before Irma. Right? So, look, I think that this is fairly. This is why this asset class is fairly uncorrelated to certain things. I mean, it's look at obviously if there's always ifs and ands, but that's why we have concentration limits.
Very good. Well, I do think that does wrap it up. So thank you very much, and
appreciate it. Thanks, gentlemen.
Have a good day. Goodbye, everybody.
Okay.
Thanks.